for an investment analysis on SOFI, which argues it's a profit machine that Wall Street just got completely wrong. What I like right away is the data. It hits you immediately with that PE ratio, 49, which really hammers home the point that this is a tech growth story, not just a bank.
That clarity is the perfect foundation. That PE shift is the whole game, really. And the report just nails that inflection point. But if the goal here is to convince, the most skeptical analysts on the street to act on this, we have to talk about how the message is delivered.
Okay.
So while high conviction is essential, strengthening the analysis report requires careful calibration of the language used to maintain analytical rigor amidst the aggressive bullish narrative.
I see where you're going. I mean, when you're being contrarian, you want to be punchy, right? Using phrases like, the last gift the market gives you before $30. But is some of that needed just to cut through all the noise out there?
That's the key challenge, isn't it? If this was for a broad retail audience, I'd say yes, absolutely. You need that excitement. But for the stakeholders who are really focused on the deep fundamentals, the ones looking at the 11-cent EPS, the 14% profit margin, that record revenue, the weakness is that this very emotive phrasing, it risks crossing the line from strong analysis into just hype.
And that can undermine the facts themselves.
It can. It unintentionally cheapens the data. When the numbers are this good, you don't need to wrap them in language that sounds more emotional than objective.
So the goal isn't to back off the conviction that Wall Street was wrong. It's to let the data create that conviction for the reader.
Exactly. The suggestion is to recalibrate the language in a few key places. Let the compelling data, like the triple beat on revenue, earnings, and guidance, drive the argument. Reduce the reliance on superlatives. You want the takeaway to be, wow, these numbers are undeniable, not, I wonder who paid for this report.
Okay, so let's get concrete. Where would you start?
Let's take the opening. Instead of calling it a gotcha moment, which feels a bit like an emotional victory lap, maybe frame the current price, that $26.82, as an advantageous entry point supported by robust Q3 metrics and raised guidance.
That lands differently. It's more professional, more aligned with how an analyst would think.
It moves the argument from a declaration to an assessment, and you can keep that same theme going. So instead of saying the company isn't just surviving, it's thriving.
You just point to the numbers.
Right. Just highlight the adjusted EBITDA of $277 million. The word thriving is already implied by that number. Removing the adjective actually gives the fact more power, more weight. The material already proves Wall Street was wrong. Now the tone needs to persuade them why it matters.
That makes perfect sense. And that level of rigor needs to flow through the whole structure. Which I think is a really good transition to our next point. Let's talk about the technical analysis section, where the report identifies that $26 range as the institutional accumulation zone.
Yeah, the technical data is laid out clearly, and identifying those price levels is useful, for sure. But the technical side feels a little disconnected from the core fundamental thesis.
So the weakness is structural? It's like it's operating in a silo? It says institutions are buying, but it doesn't really connect it back to why they're buying, based on the report's own arguments.
Precisely. It calls it an accumulation zone and a healthy consolidation day, but it never fully establishes the why. There's no explicit link explaining that institutions are adding positions because of that game-changing $33 billion deposit base or that surprising PE ratio. It just feels like a separate piece of information dropped in.
So the suggestion is to use the price action as a form of validation, to confirm that psychological shift in the market that the report is arguing for.
Absolutely. Anchor the technicals directly to the financial breakthroughs. Use that consolidation to show the market is actively reassessing the company as a growth tech story. It shows the sophisticated reader how the chart actually confirms the fundamental thesis.
Okay, I see how to make that really actionable. So, for example, in that section, you'd explicitly link the consolidation to the forward-looking guidance for 2026?
You could, yeah. Or you could explain that the $26 floor represents the market establishing a new price that justifies the 49 PE multiple. You tie it to the growth coming from that flywheel deposit effect. All of a sudden, a simple support line on a chart becomes a market assessment of future value, which is incredibly powerful.
And then you could use the chart to highlight the risk to reward. Trading 30% below those high-end targets of $38, $40. Frame that as the market validating the new reality. The EPS, the profit margin.
That's right. It makes the buy the dip case so much more analytical than emotional. And it ensures the technical section is a confirmation tool for the fundamentals, not just some isolated timing guide.
That structural integration really gives the whole analysis a professional edge. Okay, let's move on to what is probably the most powerful part of the argument. The secret weapon. That $33 billion in deposits that lets SOFI fund its own loans. the core reason Wall Street was wrong.
That deposit base is the whole story. It's the engine of the profit machine. It gives them a funding source that's so much cheaper than their competitors. But to make this contrarian case truly bulletproof, the material has to preemptively address the sustainability of that advantage. It has to anticipate the next bear argument.
So you're thinking, what are the risks here? Is there a danger that just focusing on the success might overlook the competitive landscape?
Like, what if other fintechs start chasing deposits aggressively, or traditional banks get more competitive on rates? That is the core weakness we need to address here. The report is excellent at showing how they got profitable. That cost of funding advantage is crystal clear. But a truly high-level analysis needs to explore the potential vulnerabilities in that model. By not discussing competitive pressure or interest rate sensitivity around those deposits, it leaves an opening for a skeptical reader to challenge the whole premise. They need to see that this advantage is structurally defensible, not just a temporary thing.
I get that. If everything hinges on that funding advantage, you have to prove the moat around those deposits is deep.
Exactly. So the suggestion is to strengthen the forward-looking analysis, anticipate and neutralize that next level of skeptical questions. It's not just about achieving profitability. It's about proving you can maintain it.
So we're looking for ways to show those deposits are sticky, beyond just the raw number. How do you do that without losing the analytical tone?
You point to the structural reasons the deposits stay. When you're discussing the $33 billion, you could introduce a point on why this deposit base is less rate sensitive. For example, is it because of strong cross-selling within the membership? People using checking, savings, investing, and loans all in one place? Or maybe it's the tech platform segment creating high switching costs.
That's very effective. You're showing the deposit base isn't just a number, it's a symptom of a much larger, more robust ecosystem.
Correct. And then you close that loop in the conclusion. You summarize these new risk mitigation factors that distinguish today's SOFI from the company the bears were criticizing. It reinforces that the raised 2026 guidance isn't just optimistic, it's supported by a defensible structural advantage. That adds serious intellectual weight to the whole Wall Street was wrong claim.
That elevates the discussion from a strong pitch to a comprehensive, risk-aware investment thesis. That's an incredibly valuable set of insights.